Hi friends, I'm your Chatti Buddy Kumar and welcome to Average MBA Aspirant. This video will be regarding new policy framework or new bad loan framework which is issued by RBI on 12th Feb 2018. In this video, I will be discussing what is the existing framework and why is it removed and what is the new features of the new policy framework, or as precisely mentioned by RBI, that revised framework stressed assets, and what will be its impact on short-term and long-term basis, and whether it will be beneficial for India or whether it will not be, and in what cases, in what scenarios it can be negatively affect our economy. So friends, let's start. So friends, in this section I will be discussing what was the existing framework for bank loans. So first of all, let's focus on CDR or corporate debt restructuring. What was the corporate debt restructuring? It was laid down by RBI in August 2001 to provide timely support for the companies which are in loss, but not because of their own fault. Their internal operations is viable, their financial operations are viable, but they are in loss because of some external factors. These external factors can be like slowing down of market, or currency rate have been reduced, or interest rates have been drawn up. In other words, these are the factors which are beyond the control of a company, but due to these factors a company can be in loss. For these companies, CDR was laid down. In this there was two categories, either doubtful or standard. If a loan is categorized as doubtful, then liquidation of company was done so that all investors take their money back. And if it is in standard category, then more timely support was provided to them. This timely support could be in form of extending their payment period or providing more money to them so that they can cover up their losses and be more and can run their future business. So in this type of this, or lowering their interest rates. So this was the thing which was support provided to them. Also there was a 75-25 rule which said that if 75% of investors or loan givers agree to a plan, then the rest 25% also have to agree to the plan. So as you can see that this CDR mechanism was focusing more on investors. It was putting more pressure on investors rather than on someone who has taken the loan. For example, in other words, it's equivalent of saying that suppose I have taken loan from you, then and I am in loss, then you provide me more money, and which is obviously it's not something which will be useful. So, and then there is also 75-25 rules, which that means that if the 25% that is those who were not adding earlier were small banks, then also they have to agree. And while the big banks such as ICICI or some other big banks could easily survive that much financial debt or financial loss, that would easily survive for that much period, the small banks have a problem. So the CDR was a bit failure. Out of 530 cases which CDR has handled, only 87 has passed. So you can see that CDR failed horribly. So considering that a new policy was laid down by RBI, which is known as SDR or Strategic Debt Restructuring. What is SDR? In SDR, we convert every loan into equity, and then after converting a loan into equity, we sell them. So the problem was that banks have to own at least 51%, and this is one of the feature, and they have to find a new buyer within 18 months. So this was something. This period was something which banks found too small. That that in that 51%, this all process has takes some time, and then we also have to buy a new buyer. This thing takes time, so banks were finding it too difficult, too short period. So SDR was also not working that well. After that, S4A was uh, laid down by RBI. S4A is scheme for strategic structuring of stressed assets. This policy was an improvement over SDR. It was in this, what was the main difference between CDR, between SDR and S4A, that in this quasi equity was also converted. It means that every loan was divided into two parts. One is sustainable, and another one is non-sustainable. And non-sustainable was converted into equity or quasi-equity. Quasi-equity is a form of debt which has some of the features of equity, such as flexible payment time. So, and what was the problem in S4A? First of all, it was it has a personal guarantee that if I'm a director of a company, then I have to put some personal guarantee also, and then the 50% was also in that problem. 50% shares which bank have to hold. Actually, it is not that 51% has to hold by bank. It is that 50% of the loan has to be sustainable. So sometimes it is not the case. So that's why it was also failing. So this was the existing framework. Now in the next section of video, I will discussing what is the new framework. As you have also seen that I also discussed that why the policy was failed. So in the next section, I will be discussing what is the new framework that RBI has laid down on 12th February 2018. Hi friends, so in this section of the video, I will be discussing the features of the new revised framework stressed assets, which is laid down by RBI on 12th Feb 2018. So in this, first of all older features such as CDR, SDR and S4A were scrapped. They don't exist now. Now what is the features? Now they have mentioned in the revised framework, in this they have termed everything as stressed loan, and they have termed a special mention account SMA, which is an account which has defaulted. If it has three categories: SMA 0, SMA 1, SMA 2. If a loan has been defaulted within 1 to 30 days, it is SMA 0. If it is the default is within 31 to 60 days, it is SMA 1. And if it is in default within 61 to 90 days, it is in SMA 2. And if the loan is greater than 5 billion, then the banks have to submit a weekly report to CRILC, which can be termed as a central database of RBI for loans, and just as a very on a very layman terms, it can be seen as that. So after that, if there is SMA 0 or 1 or 2, if a loan is that, then the company has to implement a resolution plan or RP. Resolution plan is something which is agreed by every investors, every stakeholders, should I say, loan banks, companies, executives, stakeholders, etc. have to come and form a plan, and which is termed as resolution plan. This resolution plan is said to be implemented if the company is no longer in default, and the they also have to undergo an ICE, that is independent credit evaluation. If the company is within 1 to 5 billion, then it has to get RP4 rating from a credit rating agency, CRA, from one credit rating agency at least. What is RP4? The resolution plan strategies have been categorized as RP1 to RP7. RP1 being the safest rating, that is this RP1 means that this loan is very safe, and it has very low risk, and RP7 means that it has very high default risk, and RP4, which is they need to get, means that this loan has moderate degree of safety. And if the company is greater than 5 billion, then they have to get this RP4 rating from at least 2 CRA. At least, they can be more than that, but they have to get at least 2. Now this RP needs to be implemented within 6 months, within 180 days. Or if this have not been implemented, then they have to file for insolvency, with which is under the framework of IBC code, which has been recently implemented by Indian government, within 15 days. So they have to file for that. And if RP is implemented, then the date of implementation of RP and the date by which their at least 20% of the loan is paid. This is termed as a specified period, and this specified period cannot be greater than 1 year. So this specified period, there should not be even a single default. If it is, then they have to file for application for insolvency. So this is for more than 20 billion. And if the loan is within 1 billion to 2 billion rupees, then the RP needs to be implemented within 2 years. Otherwise, they have to file for insolvency. So this is the features of new framework which RBI has laid down. In the next section of my video, I'll be discussing the short-term and long-term impacts. Hi friends, so in this last section of the video, I'll be discussing impacts of new revised framework on economy, and what are the short-term impacts, what are the long-term impacts, and what are some of the challenges we may face. So let's focus on impact and short-term impacts. First of all, the NPA may increase in short term. Why? Because now we have a very clear framework that you have to implement RP within such months if you have a 20 billion more, and if you have not implemented RP, you have to file for insolvency. And then there is, if you have implemented it but have defaulted even a single time till 20% of your outstanding amount is paid, then you have to file for insolvency, due to which the NPAs may rise or insolvency cases may rise in short term, and due to which market may also get impacted negatively. There can be some negative impact on market, and due to this increment in insolvency cases or NPAs, it is possible that a recapitalization amount, which is 80,000 crore as mentioned in our budget, may get eaten up by this. And RP agreement, which is that 100% of the investors and bankers and company stakeholders, means all the stakeholders, should agree to a plan. This agreement can be a bit problematic, it can be a bit challenging, because every person agreed to a single plan, that is also within 6 months, and that is also for a company which is has more than 20 billion, that is 2,000 crore. So this thing can be a bit challenging. And in long terms, it will be a bit it will be beneficial for India. Why? But also now we have a very clear framework. Now companies have brought a message that no, if we are entering India, you have to be serious towards your business. You have to be very operational. You can't take banks' money as granted. You have to pay them. If not, then you have to pay for it. You have to file for insolvency. So due to which the companies will try not to default, which will be beneficial for India. The bad loans will reduce, NPAs will reduce, and banks will have a clear. But there can be one more challenging point. Our current revised framework says that if you have not if you have implemented RP, then the amount till which 20% of your outstanding amount is paid, till that period there should not be even a single default. Now suppose I have taken a loan and I have, by some problem, I have defaulted and I have filed for RP. I have RP implemented RP. Now what has happened, that due to some external factors, suppose market slowdown, I'm not able to pay once, then I have to file for insolvency. Although that my business operation, my resolution plan was fine. I could be able to take out my market from loss, my business from loss, and emerge as a financially viable operation, financially viable business. But still I'm not, because I have to file for insolvency. That can be a bit problematic in nature. So, but if I think it should be changed that it should have a higher limit, that maybe that if you have more than one. So at least right now I think that the move is this point can be very harsh. But other than that, I think it will benefit India. So friends, that's all for today. Please like, share, comment video, subscribe to my channel, share the video, and if you have anything in mind that you would like to get a video on, please comment. Thanks.